Hi everyone, Michael Murray, Managing Director of Murray Property. Today I'm joined with Bradley Beer, the CEO of BMT Tax Depreciation. Thanks for joining us, Bradley.
Thanks, Michael. Great to be here.
Pleasure to have you. So just wanted to give a quick, to our viewers that are watching, a quick insight into BMT Tax Depreciation. What's it all about?
Yeah, sure, Michael. We're quantity surveyors, so we estimate construction costs primarily for the purpose of preparing depreciation schedules. We're a business that started in 1997. I've been there since '98. I was the first staff member.
Yeah.
We're now a business of a bit over 200 people. We're national, and we do depreciation schedules Australia-wide. So lots of houses, units, commercial properties, anything that needs a depreciation schedule we'll get involved with.
Fantastic. And is that just for the newer apartments, or also for sort of like the older Art Deco apartments and stuff as well as those houses, or?
Look, depreciation on new apartments or new houses is a little bit higher than on older properties because of the fact that they're brand new and everything in there is new. Old properties still get some deductions. There's a few things that change how much that is, but any property is worth asking the question, see if we can find some deductions, and if it's worth it, we'll do it.
Fantastic. And as you know, a lot of our clients do use your services, and a question I often get asked is what is a depreciation schedule? What's involved in it?
Well, it's a simple document that spells out how much claim against this depreciation that your accountant uses as part of your tax return. When you've got a property that's investment property, the items in there wear out over time, and that includes the carpets, hot water services, and the building itself. And the tax office has these rules that says over time you can claim a deduction, a bit like you depreciate your car if you use it for your business. You have a property, you use it for investment, you get to claim some depreciation against the items in that house or unit or whatever it is. So this document just tells the accountant exactly how much that deduction is each year, and what we do is come in and try to make that number as much as legitimately possible.
So if you have an accountant, you still need to get a depreciation schedule?
Yeah, it's a regular question. I've got a good accountant, Brad. The accountants are our friends, let's be clear on that. We are a specialist in the depreciation component. The tax office accepts the costs we come up with for the purpose of depreciation. Now, an accountant is not a quantity surveyor, which is someone who estimates construction costs. We come up with those costs because traditionally what we do is actually estimate construction costs. And we work with the accountant, we provide these numbers as just that specialist in that one area of so many things that go into a tax return for a property investor.
So once you actually get the depreciation schedule, how long does it typically last for? Does it have like an expiry date or anything like that?
Look, if you have a brand new property, you've actually got 40 years of deductions. When we do that, we actually project it for the full life. If it's 10 years old, you've got 30 years left, kind of. So we actually produce it for whatever life of depreciation is left. Now, if you do change it though, you change some things in there, you may change those deductions, but we've got an online portal where we can update it very easily, or we can update those reports so that really once it's done, it should be done for the life of that property fleet.
That's fantastic. And I suppose investors, when they're looking at doing a depreciation schedule, for them, what's some important things they may not be aware of that the accountant may miss, or something that they don't think of that they can actually deduct?
Look, there's a list. There's nearly 170 items within a property that are called plant and equipment. Carpet, hot water service, stoves, blinds. But some of the more things that are missed more regularly are things like automatic door closers, garbage bins, exhaust fans, and things that aren't as well. Exhaust fan you notice pretty much, but there's a full list of them. We actually go in and make sure we find all of those. The other thing is there's another part of these claims that relates to the structure of the building. Now, the age of the building matters here as to what you can claim, but we've got to make sure you get all of those, estimate them properly, but also these deductions apply sometimes to renovations that have been done by yourself or by a previous owner. So we go in, we find those things and make sure they're all there. The accountant does your tax return. They generally don't go out and visit your property. We actually go visit it, we find it, we put costs against it and produce a report.
So should they, once the renovation's done, should you get it done straight away, the report, or?
Look, the best thing to do is probably have it looked at before you renovate it, because then sometimes there might be some additional things you could write off, and then some adjustments after you renovate it. But look, we've done some research. 70 or 80% of property investors don't maximise their deductions properly, and they could be because they have renovated and haven't done it. Someone else has renovated. There's all different types of scenarios. Each of them needs a look. I'm an investor. I should know about these deductions and make sure I claim the most of them, and we'll find the numbers for them.
And you mentioned before about plant equipment being one of the factors. There has been some recent changes on that with legislation. How is that going to affect investors?
Look, and it's just passed through the Senate, so there has been some change in that second-hand plant and equipment won't be able to be claimed as a subsequent purchaser. You won't claim against those things. You still get to claim on some of that building allowances, and for the purpose of capital gains tax, that plant and equipment comes into play sometimes depending on many accounting scenarios. I guess the simple message is that depreciation still exists on properties. These changes make some difference to how much on certain properties, and some properties that may be worth it in the past won't be worth it now, but we'll identify that very simply up front before we go ahead and do anything. It's always think, well, I'm an investor, I might have depreciation. We talk to the specialists and find out how much it might be.
Fantastic. As a final question to investors that are out there, I suppose when it comes down to considering whether they should do a tax depreciation schedule or not, what would be your advice or message to them?
Well, simply, before you even buy a property, I think you should crunch some numbers and you should know what this cash flow is going to look like, because the depreciation makes a difference to that. So you can get an estimate for free before you buy it. But if you have got it, get an estimate, work out how much deduction it should be. We identify it's worth it, but always call a specialist to come and find out how much money might be there, because they shouldn't do anything unless there's going to be some money there, and it's pretty easy to work out. So just make sure you take advantage of the deductions that are there.
Fantastic. Well, thanks so much for joining us, Bradley. Really appreciate your time. I will be posting a comment below the video if you would need further information on BMT tax depreciation.